everyone, welcome to NDTV Profit. You're watching Know Your Company, and one stock that we're dissecting today is Sky Gold. Joining me is also Mahima Vachrajani, who tracks the sector pretty closely. Mahima, clearly with regards to where Sky Gold goes, an interesting company that we have been watching out for. The kind of growth that it has achieved in terms of the markets is fabulous. Now, the key question over here is as to why are we talking to the company? But before that, let me quickly take you through, what the company is all about. Firstly, the company is established in 2005, and they're mainly into designing, manufacturing, and marketing of gold jewelry. Now, why is this company on KYC? The first plate that you see right now on the screens, why are promoters offloading? Because that's the latest one that we've picked up in terms of promoters which have gone ahead and offloaded nearly 4 to 5% stake right now. What is the reason for that, and is this what they're looking to continue doing as well from here on? Moving on, the second question that we ask on KYC right now is, why enter the lab-grown segment in FY26? It's an absolute niche that they're looking at because bulk of their businesses in terms of gold jewelry. Getting into lab-grown, where to what we understand is 14 carat is what they're concentrating on. So we'll understand that rationale on that front. Thirdly, if you talk about the numbers, their profit growth has been higher as compared to their top line. And from a margin perspective, it's single digits. So to understand the math in terms of why this kind of a permutation combination that comes up in terms of their profit and loss account. The growth that they've been achieving, 3 digits, is this going to be sustainable from here on or not? And what is it that will lead to this kind of sustenance? And very lastly, export is another aspect that they're considering. Currently, it's in single digits for the company. The plan is to grow it to double digits, and if I'm not mistaken, it's around 25 to 30%. So what is that strategy going to be with regards to exports? And to this kind of growth that the company has been achieving, how much will exports add on? I think those are the key questions, Mahima, that we should be looking at as well. But very quickly, in terms of about the company, we were talking about what the company does. Designing, manufacturing, and marketing gold jewelry is what they're looking at. Apart from that, in terms of the business model, what's interesting is it's a B2B model. That means the company actually manufactures gold jewelry and gives it to retail companies. So that's what you're looking at from a business perspective. The products are mainly in that mid-range category. So mid-range jewelers is who pick up this kind of jewelry from a Sky Gold. Let's quickly understand their clientele. Malabar Gold, Joyalukkas, Senco, Kalyan Jewellers, and Caratlane. These are the major clients that the company has so far. But what's interesting is the names they've added in FY25. They've added names like Indriya, Caratlane, PN Gadgil, as well as Pothys and Vega. So these are the ones which have added in FY25. Whether they've given them business so far or not is a question that we will be asking the management from here on. In terms of manufacturing, their facility is around 1.3 lakh square feet, capacity of around 12.6 tons per year, and they're expanding to almost manufacture 200 kgs per month to 1 ton per month. That's what they're looking at. Product portfolio as well, let me take you through that. 9 to 24 karat gold is what they are manufacturing, and this includes rose gold, white gold, and yellow gold. Their focus is mainly in terms of lightweight jewelry, and the company has moved from generic to complex manufacturing. In 3 years, in fact, if you talk about their design team, that has also scaled to almost 110 members. So that's what it's looking like in terms of where the overall business goes. But I think Mahima could talk about more in terms of their additional foray.
Right. So, in terms of their additional foray, like Hiral was mentioning earlier as well, diamonds is something that they've made a foray into, and lab-grown diamonds is going to be, something in focus. The Sky9 brand is a lightweight and contemporary jewelry brand that they have taken on board, and this is going to focus on making lightweight diamond jewelry. Plus, in the lab-grown diamond space, they're planning to add 14 karat lab-grown diamonds. So that is going to be something to watch out for, because that is going to be something that will be more of from an export perspective, since they're also planning to increase their overall exports. In terms of their overall overall exports as well. They've expanded into the US markets as well, and they plan to grow their exports going forward as well to that 25 to 30% of the overall revenue. Plus, in terms of the business mix, around 65% is corporate and overall 35% is others, but they plan to elevate that to almost 100% in the next 3 odd years is what the management has said. In terms of the overall inventory management, the strategy is to manufacture low grammage and move towards more fast moving designs. So that's with regards to where their inventory management stands. So overall, this is the picture as to how their, of course, manufacturing takes place and what their strategy is in place here.
Lots to ask the management about. Let's quickly look at the rating parameters, Mahima. Firstly, the income statement check is what you're watching out for in terms of the first rating parameter. We'll look at the balance sheet, cash flow, return ratios. These are the top 4. Moving on, you look at the shareholding, the street credentials as to what the street is looking at in terms of the company. Valuations, we're trying to value it with companies who are actually, retailers into the jewellery segment. So that's the like-to-like comparison that we're looking at. And the street coverage along with the outlook is the key for this one. So these are the 8 parameters, Mahima. Let's start off with the first one.
Right. So for income statement, overall, the performance of the company has been good when it comes to 3-year CAGR performance and 3-year growth as well. But like Hiral mentioned at the start of the show, the key question here is as to how profitability has grown much and far better than how revenue has grown. But with respect to their overall top line growth, 3-year CAGR has been roughly 65 odd percent. EBITDA, the 3-year CAGR has been around 114 odd percent, and the overall net profit CAGR has been roughly 99%. Margins, margins have been on an increasing trend, though still in single digits. From a 3% in FY23, they've gone to around 6% in FY25. In terms of the overall revenue split right now, domestic stands at 92% and export stands at 80%. Which the management plans to grow exports to that 25 to 30% mark of the overall revenue. In terms of the volume growth has also been very good for the company. Q4 FY24, the overall volumes stood at 460 kg per month, which was a 300 kg per month in Q4 FY24. So significant amount of growth in terms of volumes as well. So overall, the entire income statement posts a good picture, which is why we've given it a thumbs up considering the overall 3-year CAGR growth as well as volume growth in picture.
So that's a thumbs up on that front. Let's look at the balance sheet and check that. Now, what's interesting is that the cash balance has been absolutely strong. If you look at FY23 to 25, the cash and bank has grown from 18 crores to almost around 175 crores in terms of FY25. So that's a strong number coming in there. If you look at the other aspects as well, in terms of the debt is something which is another matrix we should be looking at, where the cash on the books on the bank is enough to cover the borrowings of the company, which is again a strong point from here on. In addition to that, if you talk about their new facility, they're planning to develop almost 5-4 lakh crore square feet on the land that they have, and this will also go ahead and boost their production to 4.5 tons per month. In fact, they've gone ahead and looked at an acquisition, that is Ghana and Gold. That acquisition also is in progress, and they've already seen a capital raise of around 270 odd crores in the month of October 2024. So the key question that comes up over here is, with a strong cash in bank plus a fundraise that they have done, what is the reason for the promoters to go ahead and sell out stake? Though with all these parameters, we've given a thumbs up to the balance sheet.
Right. So the next parameter is cash flow. In terms of the cash flow, the overall net cash flow position has been negative in the past 2 odd years. When we take a look at how cash flow from operations have fared, they've grown to a negative 273 odd crores in FY25, which was a negative 6.5 crore in FY23. This is because of high working capital changes as well. But in terms of the overall net cash flow position as well, which was a positive 17 crore in FY25, it's gone to negative 3 crore in FY20, which was a 17 crore positive in FY23, has gone to a negative 3 crore in FY25, which is why we've given it a thumbs down for now, because overall net cash flows have remained negative in the past 2 odd years, from a negative 5 crore to a negative 3 crore, slightly downtick there, but still in negative, and which is why we've given it a thumbs down for now.
Okay, so that's with regards to where the cash flows go. Moving on, let's quickly look at the return ratios. In fact, we did have a lot of to and fro with our producers and internally as well as to what should be the rating that the company should get in terms of the return ratios. Yes, if you have to look at 2025, the return ratios are absolutely strong because the return on equity is around 21%. And if you have to talk about the return on capital employed, that stands at around 30%. But the key over here is there is no consistency that the company has been able to maintain, because it's already seen ROE of almost 22% in 2022, and the ROCE, that's the return on capital employed, has actually gone up to levels of 32% in 2023. So there is no trajectory that we are able to gauge whether it's an upward trajectory for the company or a downward trajectory, or whether it's maintained. There is a lot of volatility that you're seeing in terms of where the return ratios are concerned, and that's the reason why we're giving it a neutral rating.
The next one is a very important point, that's shareholding, and we've been talking about this throughout the show, right? Because promoters have slightly been selling their stake in the counter. In terms of the overall promoter holding, if we take a look at the last 3 odd years, the overall promoter holding has gone down from that 73.6% mark to a 58.2% mark as of March. And post that, last week, promoters again sold roughly each of these promoters sold roughly 1.8% stake in the counter and combined roughly 4 odd percent, 4 to 5 odd percent stake in the company. And because of this, we're seeing that since promoters are selling stake in the counter, we've given this a thumbs down specifically. So promoters have been holding stake in 2 different ways. One, their individual holding, and via HUF. So last week they've sold stake of the HUF, where all 3 of them held around 2.19% stake, and they've offloaded roughly 1.8% stake. So the overall holding, in terms of promoter, one thing is going down, plus FIs never, held any kind of stake in the counter, and hardly in March 25 ending, FIs hold around 0.4% of the overall stake. DIs again have seen a pickup in terms of their stake overall, which was nil in the first 2 years of March 23 as well as 24, but that has gone to up to 7%. Lastly, in terms of public shareholding has gone up from 26.5% to that 34.3% mark. But like I mentioned earlier, because promoters are slowly and steadily decreasing their stake, we've given it a thumbs down here. And the question really to ask here is that why is that happening?
Interesting. So why is that happening is one question, and the other aspect is the kind of names that are coming in as well, because if you see the trend, the DIIs have been increasing, and in the latest one as well, I think it was Bank of India mutual fund which bought around 0.5% of stake. So that is one aspect that we need to consider on this front. But apart from that, if you see in terms of the street credentials, let's quickly look at that aspect. In terms of street credentials, in terms of the stock performance, 1 month the share price is down 15%, but this is mainly on the back of the pressure the company has been facing on the back of the sale that has happened. However, on a 1-year basis, 95% is the kind of return. 6 months again similar, 26% downtick. YTD also, if you see, it's a 20% downtick that you've seen, and the actual shining part is 95% upside in terms of the last 1 year, and in the last 5 years, 13 times is the kind of returns an investor has made in terms of Sky Gold. But only because of the recent pressure, it's a neutral rating that we've given in terms of the street credentials.
Right, absolutely. And in terms of valuations as well, even this was, a point of discussion when we were giving it a rating, because overall the valuations are cheap right now as compared to where the other jewelry companies stand. There is Kalyan Jewellers, which is trading at 75 times. There is Senco, which is trading at 34 times. PC Jewellers at 13 times. Titan trading at 95 times. Sky Gold is trading at around 35 odd times, which is cheaper than as compared to something like a Kalyan Jewellers or a Titan. But overall, trading at 35 times is still not cheap when it comes to taking a look at the valuations, and which is why we've taken a neutral approach when it comes to valuations for now.
Okay, so that's with regards to the valuations. Let's quickly look at street credentials. Now, the thing is, not too much of coverage that's happening in terms of Sky Gold. So you just have a buy rating, and that's a single buy rating that's coming in on this counter with a potential upside of 74%. So hence a neutral rating on this one. So those are the 8 aspects that we've spoken about. But let me take you through the final performance rating. If you have to consider all the parameters on your screens. If you can just quickly get that one from income statement check to your balance sheet check, return ratios, cash flows, shareholding. Income statement, balance sheet, again, a thumbs up, cash flow is a down. Return ratios, as we said, that because there is no consistency, it's a neutral. Let's go to the next one. If you talk about shareholding, a downtick because the promoter has been selling. Street credentials, again, a neutral. Valuations, neutral because it's on the expensive side, not as compared to peers. So overall, a 4 on 8 is what NDTV Profit has given a Sky Gold in terms of its KYC rating. But to discuss further on this, let's also welcome in Mangesh Chauhan, MD and CFO at Sky Gold and Diamonds. Mangesh, welcome to the show and a pleasure to speak to you at NDTV Profit. Our first question coming to you is the promoter sale that has actually, worried investors right now on the streets, and that's the reason why we've seen a downtick in terms of the stock price if you have to look at the last 1 month or even on a YTD basis. If you could help us understand what's the rationale?
Yeah, sure. So we promoter is companies like completed 20 years. We have started a journey from 2005 and it's about 2025. So we have not offloaded any shares from last 20 years. We have been growing the company. We done a 2 fundraise in the company, and first we were concentrating on the company growth and company perspective. Again, in 20 years we have offloaded first time. The 3 promoters have offloaded together 4.97%. So again, we took a warrants 18 years back of 1.4%. So it will be add up in July. So net, I will be at 3.6%. We uploaded together as 3 brothers. We promoters are there. So again, we uploaded after 20 years. So between 3 promoters. And again, some mutual funds wanted to Bank of India purchase and other funds also purchase. That's why we uploaded here.
Okay, Mangesh, hi, Mahima also joining in. Just want to get a sense, Hiran and I were discussing earlier as well about this, that overall your 3-year CAGR in terms of your top line growth has been around 65% but that compared to a net profit has been around 99%. What has worked in the past 3 years when it comes to your cost optimization? Because I believe that is something that has led to a better growth in terms of profit, and at the same time margins have of course improved, but do you think there is further improvement that you expect in the margins going ahead from that 6% mark?
Yeah, 100%. We came up in our journey. You can see 2010 to 20, we work on the revenue model and customer acquisition model. And in the last 3-4 years, we came up with new products, new verticals, which add up to our margins. We came up with the studded jewelry, lab-grown jewelry manufacturing. Again, we came up with 18-karat rose gold, white gold jewelry. So this expanded our margin. And going ahead, we are going to gold metal loans, which will improve our PAT levels by 0.4, 0.5 basis. And again, we are increasing our gold, advanced gold business from large corporates, which can again add up to our gross margin and EBITDA. So we are moving ahead to advanced gold business, which customer provide us the gold and we have to manufacture for them. So we don't have to fund the inventories and all in that. So we are expecting in 2 years, 10% advanced gold business will come from that. So again, we are coming up with new verticals in 18 karat. Also, we are expanding studded jewelry, which will help us to improve our gross margin. And again, gold metal loan, our debt converts into, whenever converts into gold metal loan, it will help us to improve 0.4 basis at the PAT level also.
Okay. Mangesh, 2 questions I have. One as a follow-up to the first question I asked you about promoter selling, and second as a follow-up to what Mahima asked you as well. So you're saying you're looking at value unlocking because over the last 20 years, the promoters have not really offloaded anything, right? Is there any plan of further stake sale that could happen from promoters on the back of value unlocking? That's part 1. And from a business performance perspective as well, we don't understand the math with the profit growth being way higher as compared to the top line growth and the margins being in single digit when gold prices have been increasing in this to this extent. So if you could help us understand that permutation.
So again, on the offload basis question, we are not going to offload anything in the future 2-3 years perspective, because already we have uploaded a good percentage. So we don't want to offload in coming 2-3 years or 4 years anything on the promoter sides. Coming to the margins, you can see we are into lightweight modern type jewelries, and we have come up with many new different verticals. We manufacture for Caratlane also, and Aditya Birla we onboarded. So we came up with new verticals. We come up with studded jewelry. We came up with 18 karat rose gold white jewelry, which is improving our margins. And again, gold rates are going up, so this is changing our inventory mix. You can see our majorly our inventory falls below 1 lakh. We are into lightweight jewelry, in which impacts is very lesser of the gold rates, because lightweight jewelry is a day in day out jewelry selling 12 in 365 days. So inventory shift is there. 10 grams is inventory we are making in 8 grams. We are making the inventory much lighter with our 3D printers, with our technologies and all. So again, a number of pieces are gaining, volumes are changing, inventory shift are changing, but lightweight jewelry has lesser impact of gold rates, and that's why we have good margins in that.
Okay, Mangesh, just want to get your sense. FY25, your split was 92% domestic and 8% exports, which you've said will grow to around 25 to 30% of your total revenue. Just want to get a sense that how will this work, which export markets are you targeting, and plus try to explain us as to how the entire sourcing from Dubai for your export works for you.
So sure, we are at 8 to 9%, and we are targeting in the coming 2 years to go up to 25% from export. We are right now opening a subsidiary in Dubai to serve to UAE. So again, when we have an office in UAE, we can do a job work from our parent company, and that will help us to give the ground level support to the customer and a good rate to the customer at the UAE. You can see in India there are premiums of $4 to $5 for exporting the gold. So we will procure gold in Dubai and send the parent company for job work basis, and then we can sell at Dubai, which is the rate going in the Dubai gold prices. So customer don't want to bear the premium of the dollar on the gold, making charge they are ready to pay. So that will help us to boost our 20-25%.
Understood. Understood, Mangesh. So I think basically it's the making charges where you pay taxes, the import duty, that quotient is what the customers save as well. So that's how you're looking at that model. But thank you so much for joining us on the show. To do a quick wrap, one interesting aspect over here, Mahima, is where the promoters have said for the next 3 to 4 years, they are not looking to sell anything further. The current sale was mainly on the back of value unlocking, which they were holding for the last 20 years. And export is going to be the highlight of their story from here on, which they plan to scale up to 25 to 30%. But completely out of time. With that, it's a wrap on this edition of Know Your Company. Stay tuned for more updates on NDTV Profit.